Traditional finance theory operates on the assumption of the efficient market hypothesis, that asset prices instantly and perfectly reflect all available information and intrinsic value. But empirical data reveals a different landscape. The mathematical perfection of the hypothesis fractures when it meets the messy, human reality of the trading floor. Prices deviate from intrinsic values because human decisions are driven by emotions and cognitive biases that theory often ignores. Market volatility functions as a systematic phenomenon triggered by the specific psychological architecture of market participants. To map this, we track the chain of cause and effect, beginning with 4 core biases: loss aversion, herding, overconfidence, and recency bias. Deconstructing price volatility requires a transition from the rational actor model to a behavioral quantitative framework. This diagram illustrates the principle of loss aversion. Behavioral research demonstrates that individuals experience the psychological pain of a financial loss twice as intensely as the pleasure of an equivalent gain. When short-term volatility strikes, this asymmetric pain response takes over. Investors liquidate their positions prematurely to relieve immediate emotional stress, sacrificing long-term yield for immediate relief. This individual panic scales up into herding behavior, the tendency for market participants to abandon independent analysis to follow the aggregate actions of the crowd. Fueled by the fear of missing out, or FOMO, this mass behavior generates speculative price bubbles entirely decoupled from fundamental discounted cash flow metrics. Loss aversion and herding create a self-sustaining cycle. Irrational selling triggers more selling, while panic buying triggers more buying, regardless of the underlying economic reality. A third cognitive driver is overconfidence bias. Data shows that investors consistently overestimate their knowledge and their ability to time entries and exits, which leads to excessive, impulsive trading. This overtrading results in measurable increases in transaction costs and suboptimal portfolio performance when measured against the S&P 500 benchmark. Compounding this is recency bias, the tendency to overweight recent market events while ignoring long-term historical cycles. Related to this is anchoring. Investors fixate on arbitrary reference points, like an initial purchase price, inhibiting reactions to new macroeconomic data. These 4 core behavioral biases come together to form the underlying psychological engine that consistently drives macroscopic market volatility. Cognitive biases often remain latent until activated by shifting macroeconomic conditions. To quantify this activation, we rely on a 10-year time series analysis from 2013 to 2023. This model correlates macroeconomic sentiment indicators to the performance of the S&P 500. The primary metric for uncertainty is the Volatility Index, or VIX. Known as the Thier Index, the VIX displays a right-skewed distribution and a mean of 18.21, indicating significant fluctuations and market turbulence. This chart plots the VIX against the S&P 500. The analysis reveals a statistically significant negative coefficient of negative 25.75, meaning that as market volatility increases, the S&P 500 tends to decline. This occurs because rising volatility signals uncertainty, which triggers loss aversion and recency bias, forcing capital into safer assets. The VIX provides a quantifiable measurement of aggregate market fear and risk aversion. Conversely, the Consumer Confidence Index, or CCI, serves as a primary barometer for economic optimism. The analyst terminal shows a positive correlation here, with a coefficient of 361.60. High consumer confidence fuels herding behavior and optimistic market movements. We contrast this with real interest rates, defined as the nominal interest rate minus inflation, which represent the true cost of borrowing. Rising real rates pressure equities as the cost of capital increases. Higher bond yields provide investors with a stronger income alternative, making the risk-free rate more attractive than stocks. These higher rates trigger loss aversion, initiating a flight of capital from stocks towards bonds or cash. Consumer sentiment and the real cost of money are the primary external catalysts for these behavioral market cycles. Structural instability is often signaled by credit default swaps, or CDS, instruments used to manage credit risk or speculate on the creditworthiness of debt issuers. This chart shows an inverse relationship between credit risk and equity value, with a coefficient of negative 44.62. Rising CDS rates signify increased institutional apprehension and default risk. High CDS rates trigger herd-driven sell-offs as investors react to what they perceive as an escalating risk environment. The VIX, CCI, interest rates, and CDS rates are the measurable triggers that activate latent behavioral biases. When these fundamental biases and quantitative indicators intersect in the real world, they create observable, structural market anomalies. Speculative bubbles and crashes are the ultimate manifestation of mass herding and overconfidence. This dynamic is evident in meme stock frenzies, where coordinated retail social investing creates self-sustaining momentum loops that challenge market stability. In these events, FOMO and overconfidence drive asset prices far above their basic fundamental values. These anomalies demonstrate that the market is driven by psychological mechanics rather than pure quantitative efficiency. This dashboard identifies persistent factor anomalies, momentum, value, and small cap effects. Each is driven by behavioral pricing errors the traditional model cannot explain. We also observe post-earnings announcement drift, where stock prices keep moving toward an earnings surprise long after the news becomes public. This drift is a result of anchoring bias, as the market underreacts to new fundamental information. These structural anomalies provide constant, actionable opportunities for astute investors who recognize the underlying behavioral drivers of the market. Accurately modeling and managing market volatility requires analysts to integrate behavioral finance directly into macroeconomic analysis. Traditional finance theories are no longer sufficient for contemporary market microstructure. Recognizing these psychological architectures is essential for long-term portfolio stabilization and risk mitigation.
My investment disclaimer. The content in this video is provided for educational and entertainment purposes only. It does not constitute financial, legal, or tax advice. The views expressed are my own and do not represent a solicitation to buy or sell any of the companies or assets discussed. Always perform your own due diligence or consult with a licensed professional before making investment decisions. Design your life, but stay safe. My